competitive analysis to try to figure out sort of this of your competition and see where you should be at. And it'll also give you an idea of where you will be at. So, if you're competing in a similar product, you'll be able to, hopefully have the same margins, maybe a little bit better, which would be of interest to, This can all be sort of, as I said, like the financial statements and the market research and the competitive analysis all kind of mold together, because you can say, hey, these guys, because they're not doing things as cool as we are, they have like a 35% margin, whereas we got 40% margin because we're doing X, Y, and Z, and and that's it's gonna look good. So it'll look good for it. But yeah, I can't say specifically. It really depends on the industry. So even in the internet companies, it's going to be variable. Like Airbnb is going to be, and all these cloud rental places is going to be different than Google, which is using AdSense or something. It's getting to the point where tech companies are, it's a completely different ballgame in between tech companies. So, and then the rest we have are the earnings before interest and tax, which is an interesting number for some investors, because they'll look at this without considering anything below it. It's a nice fancy acronym, EBIT, which is a lot of investors look at the EBIT multiple, which is taking your EBIT and multiplying it by a certain number and saying that's how much your company's worth by looking at that. And so at that point then, after that, you have any interest on bank loans, and that will get subtracted out, and then you got tax at some point. And here, this is good too. If you guys do an accumulated loss carryover, which means probably your company is going to be losing money for the first 2 years, and you can write that off on future years. So you should keep track of that, like all the losses that you're having through the first 2 years can be written off. So you see, we've got a profit here of 167,000. But we've got all these losses, so we don't pay any taxes for that year because we can write it off from the previous years. So that's kind of a nice thing. All this is going to be available online if you want to take notes. You can. I know it's like feels like it's rushing through it, but anyways. Okay. So and then you come down to the net income, which you've got a profit margin on. So net income is this number, which is everything's been taken out, and that's what you got to do with what's left. And your profit margin is basically saying for every dollar, for every euro we're making, how much we have left, how many cents we have left. So in this year we had 19 cents on the dollar. So every euro we're making, we have 19 cents left on it. And then in the fourth year of this fictitious company, we've got 37 cents on the dollar. So euro. Right. So any questions so far?
So this would be if you're starting a company, you haven't started trading, you would do this, but just as a financial projection.
I should have made that more clear. Maybe this is just projections. These are just, if you're not operating as a company, you don't have any of this yet, but you want to show that you thought about it and you said, well, we're going to budget selling general and administrative because we think we're going to need this kind of office space, we're going to need this kind of personnel, et cetera, et cetera, et cetera. Just that you thought about it pretty significantly, and that you thought about it in terms of the numbers of it, and that it works. And so, because ultimately, it's all based on sort of dreams and fairy tales, like you can post, well, we're going to make, this many clients next year. But you get in some kind of market and you make some sort of, educated guess as to it, saying, well, if we get 10% of the market share, we'll do this much. If we get 20%, even better, we'll do this much. If we get 5%, it won't be as great, but we'll do this much. And so, you can kind of make what's called a sensitivity analysis, where you're saying best case, okay case, worst case, and present it like that too, where you show a bunch of different financial statements with all these different projections. So.
One thing I've noticed in your line item is marketing costs.
Yeah, that's true. Actually, because you can put it as selling general and administrative, if you want, it's like selling expenses. But if you want to, and that's actually a really good point, you can add separate marketing because it is its own department and it is its own expense. So yeah, that's true. Yeah. Okay. So anything else?
Yeah. So if your company had already existed for a few years, you would add those. You would add that income statement as well.
Absolutely.
Yeah. So would you just put that ahead of the projections then?
Yeah, definitely. Okay. And then put a nice black line down, and then say one side actual, and then the next side projections. And then they'll ask you about it too. Like, okay, well, where did you get this number from? So source it, put down the sources. And if you're getting from the internet, put down the general source where you got it from. Everything, because they're going to ask you, they're going to grill you about it, and they're going to say, what's this and what's this, and if you can't come up with any answers, then it's really going, it's not going to look good. So, yeah, so make sure you've got it sourced. Yeah.
Based on your experience, are there cases where investors don't look for income statements or projections even? I mean, like,
If it's like a best friend from high school or something, like,
do you think, for example, like, I don't know, maybe did Twitter come with an income statement or projections?
I don't know specifically, but I would guess probably, unless the other thing is, of course, if you have your business functioning really well and things are going, then the investors are going to pile on, and you may not need the income statement per se, but it's very useful, and especially because you're building sort of a business plan. This is going to be like an appendix to that. So going back, you can see the financial projections. Because ultimately you want to present some kind of return that investors are going to get. And it's like a guess, but you want it to be based on something, based on some facts.
Do you know stories where investor would be okay with a startup that has a product with nice growing numbers? Let's say I come with Snapchat, which I have at the moment no revenue model whatsoever, but I have also growing numbers. Do you think investors would be fine with this?
Yeah, I mean, they'd be happy to see, what your market research, but like again, this is like a metric, but a metric without revenue, so like how many users you have, and then showing them that there's the potential to monetize it later. I mean, every investor is ultimately different in what they're looking for, but it's sort of, if you can't show how it's going to monetize, then I think a lot of investors will be a bit wary of it. Some are quite, interested in, making sort of more speculative things because they maybe came from the tech industry and so they think, okay, go for it. Like Mark Zuckerberg maybe would be like, well, you don't have to monetize it yet, but maybe, it'll be something, in the future. So, yeah. So, I mean, it's not set in stone, I guess you could say. So, yeah. Okay. All right. That's income statement. Now on to the next one. Balance sheet, more numbers. The balance sheet, so it's called a balance sheet. The reason it's called a balance sheet is because it has to always balance. If you show an investor a balance sheet that doesn't balance, and this has happened actually before in my experience, it looks really, really bad because what it means is assets. So does everyone know what assets are? Yeah, it's like what you have. And liabilities, those are what you owe. So at some point you're going to have your assets and your liabilities, and then you've got equity. Who knows what equity is?
Yeah.
Yeah?
An equity is the basic equity of accounting is assets equals to capital plus debit.
Yeah, so it's assets equals liabilities plus
It
equity.
means those things you have is your capital, those things you use but you don't have, it's not for you, they are not for you, it's again you are using them, so they are assets but they are debit.
Yeah, but it's, okay, so in accounting it's like you've got two sides, you've got debits and credits, and I don't know if we should launch so much into this actually, because yeah, okay. But anyways, equity is on the right side with liabilities, and what happens is your liabilities and your equity are adding up to your assets always. And so you can see here we've got total assets of 1.25 million, no liabilities at that point, and a total equity of 1.25 million. Then we start to get some liabilities, 90,000. Well, if you take 90,000 and subtract it from the assets, you get this equity number. And the equity is your stake or the shareholder's stake in the company. And that's important to know because it's showing the value that if the company was liquidated. So that's yeah, go ahead.
So just to put it simply, the liabilities and equity is just to show the way you're financing your assets, right?
Yeah, that's true. Yeah, very true. And so, if you liquidate your company, let's say you have a big factory and it's worth 10 million and you got 5 million of debt on it, and you sell the factory, you pay off the debt, how much is left over? You got 5 million. So that's let's say go to the equity holders. And so this...
So that 5 million is the equity?
Yeah, in this case, so yeah. So maybe it's too many 5 million, so 10 million factory, you got 6 million of debt, you sell the factory, 10 million, you pay off the debt of 6 million, 4 million left.